If you're married and your combined estate is over £325,000, HMRC is already eyeing 40% of everything above that. And from the 6th of April 2027, they're coming for your pension too. Most married couples in their 50s and 60s assume that being married protects them. That assets pass to a spouse tax-free, the kids get the rest, and HMRC stays out of it. That's largely true on the first death. But the second death is where the bill lands. If your spouse passes and leaves everything to you, HMRC waits. When you die, the full estate is assessed. And from 2027, that includes whatever is left in your pension. The tax on a combined estate with a £400,000 pension and a £700,000 house could easily reach £256,000. Add income tax on top when the children withdraw the pension, and you're looking at up to 85p in every pound going to HMRC instead of your family. In this video, I'm going to walk you through 4 assets that need attention before your spouse passes: the house, the ISARE, the pension, and the cash you're sitting on. And I'll show you one asset almost everyone overlooks, which could cost your children the most. If you're a married couple in your 50s or 60s trying to protect what you've built from HMRC, hit subscribe now. I put out a new video every week covering exactly this kind of planning. Let's start with the asset that feels safest, your family home, because that's where the first trap is hiding. A married couple in England can pass up to £1 million to their children completely free of inheritance tax. That comes from stacking 2 nil-rate bands at £325,000 each and 2 residence nil-rate bands at £175,000 each. It's a generous allowance, but most couples are using it wrong, and a few are about to lose a chunk of it without ever knowing. I remember sitting with my own parents when they were in their 60s, thinking the same thing they did, that being married meant HMRC couldn't touch them. It took one conversation with a solicitor to show us how wrong that assumption was. Let me give you a real example. Take a couple I'll call Sarah and David. She's 62, he's 64. They own a house worth £700,000 in Surrey. David has a pension worth £400,000. Sarah has a smaller workplace pension. They have £200,000 in ISARs and £50,000 in a joint savings account. 2 adult children. And like most couples their age, they assume everything will pass to the kids without HMRC getting involved. Here's what they haven't checked. The residence nil-rate band, the extra £175,000 per person, only applies if the main home is left to direct descendants. Children, stepchildren, grandchildren. If your house passes to a trust or gets left in a way that bypasses the children entirely on the first death, you lose that band. And if your estate exceeds £2 million, the band starts to taper. For every £2 over that threshold, you lose £1 of the residence band. A £2.1 million estate loses £50,000 of the allowance. That's a £20,000 extra tax bill, just from being slightly over the line. The bigger trap is how the house is owned. Most married couples own as joint tenants, which means the surviving spouse automatically inherits the whole property. That sounds sensible, and it is fine for the first death. But it can mean the first spouse's residence nil-rate band is harder to structure properly on the second death. Switching to tenants in common gives you more control. Each person owns a defined share, and each share can be directed through a will. That simple change, combined with mirror wills, is usually enough to ensure both bands are claimed. Now, even if you've structured the ownership correctly, there's still a form that must be filed. It's called IHT 402. The executor files it to claim the unused nil-rate band from the first death. The deadline is within 2 years of the second death. Miss that window, and the surviving spouse's estate loses the first partner's allowance. For a married couple, that could be £175,000 of tax-free capacity gone. At 40%, that's a £70,000 tax bill that didn't need to exist. So the house is fixable. It takes a will update and a conversation with a solicitor about how you hold the title. But the next asset, your ISARE, is where most people make a costly assumption they don't catch until it's too late. Most people know the ISA is a tax-free savings account, and during your lifetime it is. No tax on interest, no tax on growth, no tax on withdrawals. That's the deal. What most people don't realize is that the ISA wrapper doesn't survive you. When you die, your ISA forms part of your estate. The money in it is subject to 40% inheritance tax above the nil rate band, the same as everything else. The wrapper is gone. So for Sarah and David, their £200,000 in ISAs isn't protected. If David dies first, his half sits in his estate. It can pass to Sarah tax-free because she's his spouse. But when Sarah dies, that money, now potentially grown, is fully exposed to IHT. Here's what most people miss. When a spouse dies, HMRC gives the surviving partner an additional permitted subscription. It's called the APS. It allows you to make a one-off contribution to your own ISA equal to the value of your spouse's ISA at the time of their death. So if David's ISA is worth £100,000 when he dies, Sarah can add an extra £100,000 to her own ISA on top of the usual £20,000 annual limit. The money stays sheltered from tax on future growth. But you have to claim it. You have 3 years from the date of death, or 180 days after the estate is finalized, whichever is later. After that window, it's gone. I once helped a client whose husband had died 3 years earlier. She had £180,000 sitting in a cash account earning barely anything because nobody had told her she could transfer it back into her ISA. The window had just closed. That's £180,000 of future growth she'll now pay tax on, not because the rules are unfair, but because nobody flagged the deadline. The action here is straightforward. Make sure the surviving spouse knows about the APS, and make sure the executor or your financial advisor has it on a checklist. It takes a phone call to your ISA provider. The cost of missing it grows with every year of future returns, but the ISA is small change compared to what's coming next. The pension, the asset most people think is the safest, is about to become the biggest tax trap in recent UK history. For years, the pension was the gold standard of estate planning. Leave it untouched, pass it to your children outside your estate, and they'd inherit it free of inheritance tax. Advisors told clients this. I told clients this. It was the standard advice. Then the government changed the rules. From the 6th of April, 2027, most unused pension funds will be pulled into your estate for inheritance tax purposes. That means the money sitting in your SIPP, money you saved over decades, money you never touched, will now be assessed alongside your house, your ISAs, and your savings when you die. And the 40% rate applies. But it gets worse. If you die after the age of 75, your beneficiaries pay income tax on whatever they withdraw from the pension. Their marginal rate, that could be 20%, 40%, or 45%, depending on what they earn. Stack that on top of the 40% IHT, and you're looking at a combined rate of up to 85% on the pension pot. I used to tell clients to leave their pension untouched for as long as possible. That was the right advice under the old rules. Then the 2027 change landed, and I realized that same advice, if followed without adjustment, would cost some families hundreds of thousands of pounds. Let me show you the numbers using David and Sarah. David does nothing. He dies in 2028 at age 66, and his SIPP still holds £400,000. Under the new rules, that's in his estate. IHT at 40% takes £160,000. The remaining £240,000 passes to Sarah. She's retired and draws it as a lump sum, paying 40% income tax on it. That's another £96,000. Total tax on the pension alone, £256,000 out of £400,000, nearly 64%. Scenario 2. David starts drawing down his SIPP from age 64, 2 years before 2027, at £50,000 per year. He pays 20% basic rate tax on that income, which is £10,000 a year. He uses the money to gift to his children. Over 3 years, he moves £150,000 out of the pension. His SIPP is now down to £250,000 when 2027 arrives. IHT on that is £100,000. The total tax bill, roughly £130,000. That's a saving of around £126,000 compared to doing nothing. The pension income he paid tax on wasn't wasted. It moved the money into his children's hands while he was alive, and it came from income rather than capital, which matters for gifting, as we'll cover in the next section. So the framework is this: draw down, gift and protect. Draw down your pension early enough to reduce the pot before the 2027 threshold kicks in. You pay income tax on what you take out, but at your rate, not your children's rate, and without the IHT on top. Gift the money using the right exemptions. I'll explain those in a moment. And protect the remainder by updating your nomination form to name your spouse as the first beneficiary. If you die before 75 and your spouse is named, the pension passes to them income tax free. They then have time to manage it before it becomes part of their own estate planning. The nomination form is free. It takes about 10 minutes. Most people have never updated theirs since they first set up the pension. If yours still names a parent or a previous partner, change it now. But drawing down a pension only works if you have somewhere to put the money. That's where the fourth asset comes in, the cash and savings you're sitting on, and the gifting rules that most people get wrong. When most people think about giving money to their children, they think about the annual gift allowance, £3,000 per person per year. It's a start, but on its own, it barely makes a dent in a large estate. And here's the thing, most people are gifting in the worst possible way without realizing it. There's a much more powerful exemption that very few people use. It's called normal expenditure out of income. There's no upper limit on it. HMRC recognizes it as IHT exempt from day one with no 7-year clock. But there are 3 conditions. The gifts must be regular and habitual, they must come from income rather than capital, and they must not reduce your own standard of living. That last condition is key. If you're drawing a pension, receiving rental income, or have any regular income stream that exceeds your spending, the surplus can go directly to your children with no inheritance tax at all, as long as it's set up properly. Let me show you the difference. Suppose David and Sarah have £50,000 sitting in savings. They think we'll give some of that to the children. That's capital. Any gift from capital that exceeds the £3,000 annual exemption stays in the estate for 7 years. If David died in year 3, a portion of that gift would still be assessed for IHT. Now suppose instead that David draws £50,000 from his pension in a year and only needs £44,000 to live on. He sets up a standing order for £500 per month, £6,000 per year, to his children. That comes from income. It's regular. It doesn't affect his lifestyle. That £6,000 is IHT exempt from the moment it leaves his account. Over 10 years, that's £60,000 removed from his estate with no 7-year clock and no paperwork beyond a simple record. The paperwork matters. HMRC does not automatically accept this exemption. Your estate will need to demonstrate that the gifts were regular and habitual and that they came from income. Keeping a basic spreadsheet, the date, the amount, the recipient, and where the money came from is usually enough. It takes 5 minutes to set up and it saves thousands. I don't know every detail of your finances, but if you're living off your pension and have more coming in each month than you spend, this is one of the most effective ways to move money out of HMRC's reach while you're still alive and well. The trap most people fall into is treating their pension income as pocket money and their savings as the real asset. In terms of gifting, it's the other way around. Income is the gift. Savings stay put until you need them. So you've got the house sorted, the ISA claimed, the pension being drawn down, and the gifting set up. But there's one more thing that catches almost everyone. And it's not an asset at all. Earlier I mentioned that a married couple can pass up to £1 million to their children inheritance tax-free. But there's a catch that catches a lot of families, and it doesn't involve the assets at all. The residence nil rate band, the extra £175,000 per person, is not automatically applied. On the second death, the executor has to file a form with HMRC called IHT 402. This claims the unused nil rate band from the first death, and transfers it to the surviving spouse's estate. Without that form, the allowance is simply not used. The deadline is within 2 years of the second death. That sounds generous, but in practice, many families are still sorting out probate, selling property, and dealing with everything else that follows a bereavement. The IHT form can quietly fall through the cracks, especially if the executor is a family member who has never done this before. Missing the IHT 402 deadline can mean losing £175,000 of tax-free capacity. At 40%, that's £70,000 in unnecessary tax. The fix is simple. Write a short note, either in your will or in a letter of wishes that sits alongside it, reminding your executor to file IHT 402 within 2 years of your death. You can even name the form specifically. Your solicitor can add it to the checklist they maintain for your estate. This one doesn't require any financial restructuring. It's a procedural step, but skipping it costs tens of thousands. Now you have the full picture. Let me bring it together with a simple list of what needs to happen. So let me bring this together. First, the house. Check whether you own it as joint tenants or tenants in common. If you want full control over how each share is passed on, switch to tenants in common and update your wills. Make sure both wills are written to allow the children to inherit the property on the second death, which is what triggers the residence nil rate band. Second, the ISER. If one spouse dies, the surviving partner has a 3-year window to claim the additional permitted subscription and keep that money in a tax-sheltered wrapper. Make sure your executor and financial advisor both know this exists. Third, the pension. If your SIPP has a significant balance, start thinking now about drawing it down before the 6th of April 2027. You'll pay income tax on what you take, but at your rate, not your children's rate, and without the inheritance tax on top. Update your nomination form today to name your spouse as the primary beneficiary. Fourth, gifting. Set up a regular standing order from your pension income to your children. Keep a simple record of the date, amount, and source. That's all you need to establish normal expenditure out of income and remove that money from your estate with no 7-year clock. Fifth, remind your executor about IHT 402. Put it in your will or a letter of wishes. 2 years from the second death. That one form can protect £175,000 of tax-free allowance. None of these steps require you to be a tax expert. Most of them take less than an hour. The cost of doing nothing is 40% of your estate, or up to 85% on your pension under the new rules. If you found this useful, hit subscribe. I put out a new video every week on exactly this kind of planning, keeping your money in your family's hands, not HMRC's. The rules are complex. The actions are simple. Start today.